Principles of Accounting, Chapter 25. In Chapter 25, we talk about performance evaluation. So, how we reward goals and how we motivate our employees to hit those goals. When we're creating accounting systems, we want to create accounting systems that automatically motivate our employees to meet goals. So what we do in that is we want to set goals and objectives through planning. That's part of our budgeting process. And we want to make sure those goals are stretch goals but attainable goals. We measure the progress towards those goals and provide feedback. That's part of the variance analysis and our performance evaluation, and then we would allocate rewards for progress towards that goal achievement. So when we look at this, first we create and set goals. That's the creation of our budget. Then we measure progress. We compare our budget to our actual results. And then we provide feedback. So this is, do we need to change our goals? How do we change our budget? What are the results? How can we improve information going forward? We have several different measurement activities that we can do. We've already looked at variance analysis and we've looked at financial statement analysis. These are all different ways that we measure how a company is doing in order to determine if they're meeting their goals. Other ways that we can do this are one with what's called a DuPont system. So the DuPont system is one of the first systems that was ever created to measure business performance. So they wanted a method of measurement to help them set goals and measure progress. They looked at performance evaluation systems, and those systems are still being used today. Those calculations within the DuPont system consist of return on investment. So return on investment is used to evaluate business performance. It's also called the DuPont system. So when we're looking at return on investment, we're looking at our operating income to our average total assets. So it's the ratio of our operating income to the average investment used to generate that income. So our return on investment is a component of our capital turnover and our return on sales. Capital turnover is sales divided by investments, and return on sales is earnings divided by sales. Our capital turnover tells us how well the capital invested in assets is generating sales dollars. So we're measuring the amount of sales dollars generated from each dollar we invest in capital investments. The return on sales shows us the operating earnings or profitability that can be expected from $1 of sales. So when we do that net income divided by sales, that gives us the idea of how much net income is generated per dollar of sales. But what we want to focus on is operating earnings because we want to remove interest and tax payments from that. So here's some accounting information for a company. We have their sales, cost of goods sold, operating expenses, operating earnings, and the average capital invested in assets. We look at their ROI, return on sales, and capital turnover for two different departments in year 1 and year 2. The company has fine china and cookware, and we have 2 years of information. So what we can see is that the ROI, or the return on investment, has increased from year 1 to year 2. The return on sales increased for fine china, but decreased for cookware. And the capital turnover increased for both divisions. So when we look at this, we see that a 30% return on sales means that each sales dollar generates 30 cents of earnings. In the cookware division, each sales dollar generates 52.5 cents of earnings. We need to know what that return on sales looks like in relation to our cost of goods sold and operating expenses. So here we see a return on sales. In year 2, the manager of the Fine China division was able to increase revenue from 1.5 million to 1.7 million without a proportional increase in cost of goods sold. Cost of goods sold did increase, but it wasn't in the same proportion as the increase of sales. So we see here that we had a revenue increase of 13.3% versus a cost of goods sold increase of 12%. This helps us increase our bottom line. We can also look at the cookware division. So the cookware division didn't fare as well, and part of that is because they did have a cost of goods sold increase. They also had operating expenses increase. So when we look at the DuPont method to analyze, we show that revenue remained constant while cost of goods sold and operating expenses increased. The capital turnover ratio for Fine China shows us that the division is creating 25 cents of sales for each dollar of invested capital. So the turnover ratio improved in year 2 to 27.4 cents per dollar of invested capital. And how was that component put together? Well, we had a sales increase and a capital increase. So we increased sales without a proportional increase in average invested capital. The additional capital expenditures significantly improved our sales revenue. The return on investment, or looking at our DuPont method, is highly utilized in performance evaluation. However, there are criticisms of using that. So one of the criticisms is that managers who are measured and rewarded only on their ROI look at increasing profits and decreasing capital in ways that don't always serve the best interests for the whole company. Some of those reasons are, one, we focus on a short horizon problem. So if I focus on increasing my income and reducing my capital investments in the short run, I'm not making long-term decisions for the whole division as a whole. One of the reasons I'm not concerned about those long-run decisions is that if my bonus is dependent on this period, I'm worried about the short time frame. I might not even be here in the long run. We also might not take profitable investments. So we might have really good investments that are going to affect our division's ROI. If I'm evaluated strictly on my division's return of investment, I'm not going to take on capital investments that are going to reduce my ROI, no matter how beneficial they would be to the company as a whole or to the division as a whole in a long run. The last criticism of ROI is the difficulty in measuring both the invested capital and the actual operating earnings associated with that capital. So many units share invested capital, and the allocation of that capital between those units is not easy to separate. So if we think about the cookware and the Fine China divisions, we might be in the same building, which is a capital investment. So any improvements to that building are really going to affect both divisions. Again, we might have resource and development. We also have administrative costs. So all of those different investments, if we buy new software for the accounting department, that's a capital investment that we can't always determine how that benefited cookware and the China division just on their own. So we usually really struggle how we make those allocations in order to evaluate business performance. So how do we allocate out those investments to really look at an ROI without skewing it as part of this measurement issues? We have two different ways to do that. So residual income and economic value. These other financially based performance measures were created to help with some of the criticisms of the return on investment. And we'll look at how to calculate these in the next video.